Ever felt that gut punch, that sinking feeling in the pit of your stomach? It happens when you glance at a headline and think, with a tinge of regret, did I miss out again? Was I too slow to the party? That's FOMO, fear of missing out, a very real phenomenon. And right now, it's hitting young investors in India particularly hard, creating waves of anxiety and second-guessing. The reason for this surge of FOMO, gold ETFs. In June 2025, investments in these funds skyrocketed, experiencing an unprecedented surge of over 600%, reaching record highs, shattering previous benchmarks, and grabbing everyone's attention. Suddenly, everyone's talking about gold, from seasoned investors to casual observers, as the world feels shaky, trade wars escalating, global conflicts intensifying, and central banks strategically hoarding gold. When uncertainty rises and the future seems unclear, people rush to safety, seeking stable ground amidst the turbulence, and gold has always been the ultimate safe haven, a timeless store of value in times of crisis. But with prices soaring to seemingly unsustainable levels, you might wonder, is it too late to get in on the action? Am I just chasing a trend that's about to reverse, potentially losing money in the process? The answer, as with most things in the world of finance, isn't simple or straightforward. To decide whether gold is right for you, you need to understand what gold really offers beyond the hype, and more importantly, how it strategically fits into your overall long-term financial plan and investment goals. Is this the end of the gold rally, a temporary bubble about to burst, or just the beginning of a sustained upward trend? Let's dig into the underlying factors and examine what's really happening with gold ETFs, separating fact from fiction, and ultimately what it all means for your hard-earned money and your financial future. Let's peel back the layers on this golden onion and uncover the truth behind the headlines. Gold ETFs aren't about physically buying jewelry, gold bars, or coins. They're a digital and convenient way to own gold, mirroring the ease of buying a stock through your brokerage account. You buy units through your demat account, just like you would with any other stock or exchange-traded fund. Each unit represents a small fractional amount of pure gold bullion, which is then stored securely in a vault by the fund managing the ETF. No storage hassles to worry about, no insurance policies to take out, and absolutely no worries about the potential for theft. You can easily buy or sell anytime the stock market is open for trading. Fast execution, high liquidity, and completely transparent pricing. But the real question is, why should you even consider owning gold at all? It's widely considered a safe haven asset, acting as a shock absorber and providing crucial protection for your investment portfolio, especially during times when markets experience a significant crash or when inflation begins to rise rapidly. Gold isn't typically meant for explosive or rapid growth. It's primarily there to provide stability and long-term value, not to make you rich overnight with sudden gains. Many often mistakenly view gold's occasional price spikes as a quick and easy, get-rich-quick opportunity, but that's simply not its intended role within a portfolio. Think of gold more like the brakes and airbags in your car, providing essential safety features for your portfolio, rather than the engine that drives it forward. Its primary job is to protect and preserve your wealth during turbulent times, not to be the driving force behind its overall growth. Understanding this fundamental concept is absolutely key to smart and effective gold investing. Gold should be viewed as your financial safety net, providing a cushion during market downturns, and definitely not as your portfolio star player. Meet Ananya, a 28-year-old software developer with a solid equity SIP plan. Suddenly, her social feeds are buzzing about gold ETFs, and FOMO kicks in. She's tempted to pause her equity investments and go all in on gold. But Ananya checks the data. Over 25 years, equities have outperformed gold, which tends to surge only during crises. Gold's returns are volatile, while equities offer steady long-term growth. She realizes gold isn't a replacement for stocks. It's a companion for balance. The real question: how much gold does her portfolio need for protection, not profit? Ananya shifts from chasing trends to making a strategic, informed decision. She moves from FOMO to smart investing. That's the difference between gambling and building wealth. Experts agree, gold is a defensive asset, not your main growth engine. Chetan Shenoy recommends keeping gold to just 5–10% of your portfolio for protection during downturns. Equities should remain your core wealth builder, especially for young investors. Nehal Meshram adds, gold ETFs are best for pure gold exposure and hedging risk, not for chasing returns. Don't confuse gold ETFs with multi-asset funds. Gold ETFs are a tactical tool for safety. The recent surge in gold inflows is driven by short-term fear, not long-term fundamentals. Experts warn, don't let hype derail your asset allocation. Your total defensive assets, debt and gold, shouldn't exceed 20-30% of your portfolio. The rest should be in growth assets like equities. Stick to your plan, not the headlines. So, are you feeling the pressure? Are you late to the gold ETF party, swept up in the hype? No, because it's not a party with fleeting thrills, it's a long-term safety net. A shield against the unexpected storms of the market. Gold is your portfolio's insurance, a safeguard that can help preserve your capital during times of uncertainty. It's not a lottery ticket or a get-rich-quick scheme. The recent gold rush reflects global anxiety and economic jitters, not a permanent shift in the fundamental landscape. If you have no gold, consider a modest 5-10% allocation. Not for fast gains fueled by speculation, but for long-term resilience and stability. If you already have a well-thought-out and diversified equity plan, don't abandon it or deviate from your strategy based on short-term market noise. Chasing performance often leads to costly mistakes and regret. Stick to your well-defined strategy and long-term goals. Gold is a seatbelt, providing essential protection, not a race car promising unrealistic speed. It helps you navigate the market's twists and turns and finish the journey safely and securely. True wealth is built on diversification across multiple asset classes, not solely on gold. Ignore the FOMO and the fleeting trends, focus on your long-term financial goals, and use gold strategically for stability and risk management, not for chasing fleeting speed. Your future self will thank you for your patience, your wisdom, and your disciplined approach to investing.